Mark Shaw's in the Pattern Trader. It's Tuesday, August 25th, and unless you've been living in a cave for the past 3 or 4 trading days, you'll know that the markets have been in absolute pandemonium. In the last 3 trading sessions alone, the U.S. stock indexes have given up about 10% just in 3 trading days alone, which is, I think, a historic number. 3 trading days in each session, at least 2 or more% per day on the downside, and we've given up about 13% in the last 2 months. The primary catalyst for this has been China. There have been several devaluations of their currency, the yuan, and there was some negative manufacturing sentiment out of that economy, indicating that there may be a slowing out of that country and the ramifications it might have around the world. So basically, my email has been, going crazy. People have been calling me, Mark, what's going on here? I've been watching CNBC, which is a U.S. Cable channel, a financial cable channel, and we're getting all kinds of conflicting reports. And we'd like to tell you, tell us what's going on here. I did do a special report exactly 1 month ago, July 26, in which I gave a sell signal on the NASDAQ 100 right here. We saw a key reversal, but that in and of itself wasn't the primary reason for our sell indication, but we were the first ones to really sound the alarm bells and say that there's a real ominous problem, technical condition going on in the U.S. stock markets. So I'm going to dig into each one of these indexes and show you what was behind my reasoning there. So the first thing was I saw this negative divergence starting with the NASDAQ 100, which in the late July time frame, we went ahead and made a new high in the NASDAQ 100, but at the same time, the S&P went almost to its old high. So we formed this little double top here, did not exceed the old high. But really what tipped me off here, and was my primary concern, was that down here in the Dow Jones Industrials, we didn't come close to making a new high. I know that these charts are a little bit crowded now, and you can't see very clearly. But right here, the market was about 18,400, and right here, it was about 18,100. So we had a tremendous negative divergence or bearish divergence between the high made in the NASDAQ 100 and the Dow Jones. So basically, we made a new high in the NASDAQ, and we didn't reach a high in the Dow Jones Industrial. So that was, first indicator that that there was something going on here. When one major index goes to a new high and the other ones don't follow, that was what we call a bearish divergence. So I'm going to dig into the charts in a more compressed time frame to give you an understanding of exactly what I was looking at before I issued my sell recommendation. And we will have, I think, a silver lining when we're done with our analysis as to where the markets might be headed from here. So we're now taking a closer look at the NASDAQ 100 daily chart here for the last 6 months or so. And we did issue a sell recommendation right here, July 26th, based on this outside reversal, this key reversal down where it made a new high, closed on the low of the day. But that was just one component of our strategy. What really set me off was a pattern that I've seen over and over again in these bear market conditions. I remember when I was at Bridgewater Associates back in 1987, Bridgewater managed about $170 billion. And when Black Monday came around, we saw many of the same positions and technical formations that I'm looking at now. The same thing occurred when I was with Merrill Lynch, and the crash of 2000 came around. Same thing. We either saw these what's called a reverse wedge triangle, with the its sister being the descending wedge triangle. But this is called a reverse wedge triangle or a megaphone top because of the pattern that it sets here, where basically you have an ascending set of highs and a horizontal low. And what it sets up for is a bear trap where it looks like it's going to new highs, everything looks okay, but as you can see, if you set it against this pattern, which is a bearish pattern, I had a feeling that based on prior experience, we were going to see a complete repeat of previous history. And again, that's what these charts do. You don't have to be a genius. You don't have to know a lot of fundamental information. I know you see these analysts who are being paid these fancy salaries on CNBC. It drives me crazy. There's a chart in the background where you've got a descending wedge or a double top. Looks like the stock behind him is going to hell in a handbasket, and he's giving a fundamental report on the most recent earnings and projections and things of that nature. And the market is anticipatory. It is a discounting mechanism. So even though we had the catalytic events, with China and some of the other things going on this week, this has been building for some time, and the market is always well ahead of the news. It discounts, 3 months or 9 months ahead of the time when the information's released. And by that time, it's too late. The market's already moved. And, if you're trading off the information off CNBC, you've missed it. I always say if, we could all trade, by reading the Wall Street Journal, we'd all be rich. The markets don't work that way. The markets anticipate all this information. By the time it's released, the markets have already moved. And those who understand price patterns and price action, will understand that these patterns recur over and over again, and they always mean the same thing. We did a report this week on the euro, where back in March, April, the euro set a double bottom at the 105 area, despite all the ECB quantitative easing and the Greek debt crisis and all the bearish news and backdrop of the euro. We knew that because of that double bottom at the 105 that the euro was going to move higher, and this week it moved like 700 pips to the 117 area. But let's keep our focus on the NASDAQ and the stock indexes for the moment being. I just wanted to make a point that these patterns are recurring. We see them time and time again. I've seen them many times in my career when I've been managing money at big firms like Merrill Lynch and Bridgewater Associates, and I managed money for Coldwater Commodities, which is a division of Goldman Sachs. And I've seen these formations over and over again, so that even though I was early and in my report I said I might be premature, I kind of had a feeling of what we were in for. And at that time, I said that if the market were to drop to this 4,300 area, then the reverse wedge triangle would have been confirmed. And then because of that confirmation, we would be able to see what the potential size of the follow-through move being. So we can measure from the top to the bottom of this triangle from 4,300 to 4,700 was 400 points. And so based on this low at 4,300, we said a measured move, another 400 pips would take us to 3,900. And guess what, folks? 2 days ago on an intraday basis, this market hit 39.02 on a dime. So these patterns do work, and their outcomes are not unknown. So all you have to do is know a couple patterns, and you can make a fortune in these markets. So the question is, where are we going next? Is this a 2008 financial apocalyptic situation? Is this a 2000 market meltdown? I actually think it's a little bit more benign than that. What we've had is just a pent-up situation where this has been the longest bull market on history without a 10% decline. So I think since 2008, we've been going straight up, without a material decline. And as I always say, the trees don't grow to the sky, and neither do the markets. So I think there was a lot of pent-up energy, and there was some catalytic events that came out of Europe and China that spooked the market, and it was a good excuse for the market to purge a lot of the excesses, get a lot of the weak hands out of the market. And so one of the things I'll point out is that this reverse wedge triangle is an extremely unreliable technical formation. That while the initial implication when it breaks out, it will break hard to the downside. We did see this measured move, but a lot of times these patterns fail, and oftentimes you'll see the market actually go in the reverse direction. So the final confirmation is whether this market turns around is if we go back to the neckline here at the 4,300 area. And we might see a couple of attempts where we hit the 4,300, bounce back off, and we might have 3 attempts. And if it goes through on the 3rd attempt, then this bull market will be indicated that it will be renewed on the upside, and that will be good to go. So based on some early signs that I'm seeing in trading session today, I'm actually taking a nibble right now at these lows. We don't have a kind of signal that we usually do, but I am seeing an indication tonight that we're starting to turn around. I don't know why this is showing that it closed right here today, because it actually closed lower. This market went higher and then failed, which was of some concern. But then in tonight's session, we went lower, and now we've turned through yesterday's session close, which is something that I always like to see. And once it turned through the unchanged level, I've started buying lightly here with my stop right here. I'm taking a very small risk for what could be a pretty sizable upside here. So if you would like to follow my trades, click the link below. We'll send you 14 days of trades absolutely free, and you'll get an insight into my thinking in many other markets. So for now, that's a wrap up. So I wish you a healthy and prosperous trading day. Bye-bye now.